And then you get to the Australian miners and it becomes a game of, well, who's partnered with who? And for us, as an example, a concrete example for investors, we bought into Azure, which has that very promising discovery up at Andover. But, if you look at it and you ask yourself the question, as we did, maybe we should look. Well, that's because SQM had already taken 19.99%.
Like, who are the real winners in the commodity game as a result of the IRA?
I think there'll be winning partnerships, if you will, across the supply chain at the margin, because South Korea is the second biggest battery manufacturer. I think you're going to see them take share from China. There was a bifurcation of prices for rare earths in China, and what it led to was a natural market mechanism where if you could smuggle rare earths out of China and achieve the high international price, you would.
G'day, money miners. Today is Thursday, 3rd of August. I got the wonderful Jonas Dorling in the house with me today. JD, how are you?
I'm doing well. I think it's glaringly obvious that Matty Michael is out of the office today. Trav, how are you going, mate?
Very well, mate. Surprisingly, Matty not here, and there was no State of Origin yesterday, so he's just, there's no excuse really for this poor performance, Matthew Michael. Very, very disappointed. But we've got a great guest today, don't we?
Yeah, we've got a bit of a treat for the money miners. So we are interviewing Kingsley Jones. He's the founder of Jevons Global. He's got quite an interesting background. So PhD in theoretical physics, studied physics and maths more broadly. He's had various roles as head of quantitative trading at AllianceBernstein, also co-head of international equities at Macquarie Funds. So yeah, he's come from quite a scientific, fact-based sort of, as he'll elaborate on in the discussion, background. And yeah, he's just got some great, interesting takes across the critical metals space, across various things like the IRA, smelting, a whole bunch of different things. So I really enjoyed this one.
Yeah, you can tell he absolutely thinks really deeply about the landscape of critical minerals, how they, how the markets for each of them are evolving, and nothing is playing more into that than the geopolitical dynamics right now, which unfolds in this conversation, which was an absolute delight. And so I hope the money miners enjoy this one. Shout out to Terra Capital, partners of our show. Thank you very much, Terra Capital, bringing this podcast to your ears and hopefully your screens as well. Great fund managers out there. And according to Matty Michael, also winners of the best mug to appear in the AFR.
That's it. Thanks, guys.
We've lost Matthew Michael, but we've gained someone a lot smarter than Matty anyway. So I think we'll be okay on this one today. We've got the pleasure of talking with Kingsley Jones. And now, JD, you've been reading a bit of Kingsley stuff on Livewire. He's had a bit of an active presence. I know, he pops his face up on certain Asian broadcast stations as well. So I think we're going to have a pretty interesting discussion today about critical minerals more than anything else and all of the things relating to that sector, both macro and micro.
Yeah, I'm super excited. Like you said, Kingsley's done a lot of writing on Livewire, speaks on various channels. So I'm super excited to have him on the program. Kingsley, how are you?
Fantastic. Good to be here.
Great. So why don't we start nice and broadly and you just give a bit of an introduction on yourself and Jevons Global, the firm you founded, and what you guys are all about.
Yeah, thank you. So at Jevons Global, I founded the firm when I left Macquarie Group back in 2011, and my background is about 25 years in the industry. I didn't start in finance. I actually started, of all places, in physics. And what drew me into finance was obviously the opportunities, to invest globally. And I had been doing that actually before I entered the industry with my wife, just, on our personal account. So that's my background. Finance wasn't my first choice, if you will, but it's something that I found to be very interesting. So when I set up the company, as I mentioned, I'd been with Macquarie Group. I'd been co-leading the international equities team, and we ran a series of different so-called thematic portfolios globally. So these days, thematics is a pretty common way to invest. Back then, it wasn't so much. And the way that we interpret thematic investing is you really have a look at some of these longer-term trends, and you try to understand industry structure, value chains, supply-demand balances and the like, and just zero in on what you think will be some good core holdings and also perhaps some good trading positions. So I'd started doing that at Macquarie Group, period 2008, 2011. And the segue into how we founded Jevons was, of course, in the period 2011, the former commodities cycle started to peter out a little bit, and I was looking for some new opportunities. So I set up this company with a view that we'd be able to take a bit of a deeper dive for the longer term on some of these thematics outside of the product-driven environment that we have in mainstream funds management. So that's us. We're a small company. We're based in Canberra these days. There's two of us in the firm. It's actually my wife and partner who helps me with the other part of the business. We have client base now extending back over 5 years in model portfolios. So we've picked stocks and suggest portfolios for independent advisors. They buy those and they pay us for that service. We've been doing that in Australia for some time, and our hope is next year we'll get our first global one up and running. And you mentioned Livewire, and I have been, going back into my past, as it were. I used to actually write research for Credit Suisse all the way back in 2001 through 2002. And we've been doing some research pieces on critical minerals just to give people who are maybe independent investors, self-directed, a good read on some of these important things that are easy to miss when you're understanding this kind of complex area with all these exotic minerals, the geopolitics, the market demand and the like.
Kingsley, I'm keen to dive deeper into that background you have. So I noticed you'd studied theoretical physics, so a very scientific-based background. And I want to hear how you balance that super fact-based scientific background with the more qualitative, storytelling nature of investing and, us ultimately all being humans in this market.
Yeah, that's a great question. And you will appreciate being over there in Perth, right at the heart of this critical minerals boom.
Where all the hot areas, mate.
Yeah. The hard science actually matters. I mean, we know that. I mean, that's why we have, JORC reports and, geologists droning on about their drill hits and the like. But equally, we also do need to engage with investors about the why of it. And so the way I balance that, with a scientific background with the need to, should we say, market what we do is really through a device that I haven't shared too much publicly, but we aim to do so going forward. And this is doing the equivalent of a GDP analysis. You look at the actual revenues that are associated with a mineral commodity. You figure out what the concentration is in terms of, how many miners are there and what market share is attached to a particular country, a particular province, a particular company. And then you try to relate that to the opportunity. So you explain to people, look, some things are steady eddies like iron ore, you can be volatile, huge market, you've got to have some of that in your portfolio. Lithium's emerging to be a major growth dynamic. So if you're looking at revenue growth within a commodity, I mean, that's really spectacular right now. And then some of these other areas like vanadium, they wait in the wings. And we need to explain to people that they have a lot of promise with redox flow batteries, but it's still about 95% of the market is a steel additive. So most of the market is growing in line with steel. So what we try to do there is just tell those stories, make them relatable, relate them to dollars and cents, and give people a few anchors about, what the map of the world looks like in terms of where you want to go, and also what the economic map looks like in terms of where you'd put pins on the map to find dollars underground.
And so most of the people that we've spoken with in the past have a sort of mining engineering background or, finance type background. What's the attraction to commodities and to mining for you coming from your background?
It's really the analytical dimension of, if you have a scientific background and you get familiar, you get over that hurdle. We all have to get over the hurdle in mining of all the jargon and understanding, what it all means. And attaching importance to drill results and the like. But that's a pretty quantitative discipline, so it's quite natural for anyone who sticks at it, who has a scientific background, to get over that hurdle. But beyond that, even folks who are in the mining industry themselves are sometimes going to struggle in getting their hands around the equally important market dimension, like who are we going to sell to, where are they, and how eager are those people to buy the commodities as a final product. And that's where the combination of, in my case, a quantitative background in physics, the ability to get the data, but also to represent it and analyze it in ways that speak to the meaning, the importance, the economic significance of the commodities. That's the key attraction for me. And we find a gap in the market doing that. Most folks aren't really looking at the world in this way.
I think understanding that market dynamic is, an ever increasing part of the toolkit, especially as all these niche commodities become a lot more mainstream with some of the mega trends that are happening. And you talked about starting, your business basically on the backstop of trying to anticipate some of these thematics. Back in 2011, what were the thematics you were interested in?
We got introduced to them by our client base. So if I may go back to those days, beginning 2008, I had joined Macquarie from a different investment group where I'd actually been doing a completely different thing. I'd been managing global trading research for them. That was my qualitative background. But I'd been working in portfolio teams and I knew quite a lot about this area. So I joined Macquarie to set up some largely quantitatively driven investment portfolios across 4 key thematics. Infrastructure, which is kind of obvious for Macquarie, minerals and energy, which is a great global area for Australians to play, food and agriculture, which is maybe not so well understood, but in a farm to fork context, that's really good globally. And we also did climate change, renewable energy and different equipment things. And through that experience, I had been introduced to clients in Japan. We won some money out of Japan to run a minerals and energy portfolio. And we had other Japanese clients who at that time, remember this is 2010, 2011, were extremely concerned about losing access to the rare earth complex, where Japan uses those to make magnets, a whole bunch of other things. And in the China-Japan crisis about Senkaku Islands affair, old ancient history now, China had limited export of rare earths. And so the prices just went crazy. I'm sure everyone's aware on who's listening, but that period, 2010, 2011, prices just went to the moon. And we had clients in Japan who wanted me and my team to develop what the Japanese then called a rare metal strategy. So we have to be careful here. Rare metals is not just rare earths to a Japanese investor. It's the equivalent of what now we call critical minerals. So there's all kinds of different terminology flying around, but they're basically the same thing. And in trying to help those clients build their investment strategy, I and my team, we invented a simple little tool where we constructed a commodity GDP. I mean, it's really simple and people don't do it. But what you do is you get a good data source, you multiply out the tons by the average price and you get the revenue. And then you deflate that by, an inflation measure. So what you're actually doing at a global scale is the equivalent of figuring out, well, how big is the GDP of Brazil? You're figuring out how big is the GDP of iron ore or lithium or whatever. And when we looked at the world through that lens, everything became a whole lot clearer in terms of where you needed to put your effort. So the critical minerals, as we all know, they're very, very important, but few of them represent a large part of the commodities pie, if you will. And certain of them have a very small share of pie, but they're very necessary for advanced applications such as we've heard. And this is what the Japanese were concerned about, right? Making sure that they had enough rhenium, for example, to go in turbine blades for a jet fighter was one application. So once you understand that, you can then focus in on where you think the right places to invest are and what the right strategies are for investment. So obviously for rare earths, you can mine those, but as we all know, you've got to separate them, and that's really quite difficult. And so that becomes a critical factor for that group of minerals. For other things, like I mentioned with rhenium, it's a tertiary product of copper smelting. So you got to produce the copper, then you got to produce the molybdenum off the back of your copper smelter, and then off the back of the molybdenum, you produce the rhenium. And so therefore, there are all these sort of interesting little niche opportunities that relate to how you get different minerals. So that's the basic thing. We were introduced to the whole rare metals complex by the Japanese. We went down that rabbit hole, realized that it was a thing, and that it would require development of different ideas about how to, identify where the real opportunities were.
Kingsley, before we go even deeper into the sort of commodity complex, I'm keen just to get your thoughts on the broader macro setup we've got at the moment. So obviously in the US, there's been a huge wave of interest, predominantly in big tech and AI driven. And I just noticed you've written a few parts on this. So I'm keen to hear a bit about what you think of the broader macro environment, perhaps tying in interest rates into all of this, just to start us out.
Yeah, absolutely. I mean, I first entered the finance industry in 96. So, I was, excuse me, I was, I think in my early 30s back back in that at that time. And I was looking for if you will, a career change, a different career, because I've been in scientific research a long time. And back then, the reason for mentioning this is that, we were just really in the middle of this long period of interest rate decline. And back when I had finished high school and gone into the uni in the early 80s, that's when interest rates were 18%, crazy numbers, that sort of thing. And so we've had this long period where interest rates have just been steadily declining. And our belief, with the macro is that basically that's done now. So the really big question is whether we're going back into, heaven forbid, a repeat of my childhood with 1970s and stagflation. I don't think so, actually. Or we're going to find a new kind of happy medium with a new level for interest rates that just goes sideways for some time. I think it's probably the latter. And I think that with the rise of geopolitics and competition between the United States and China, one of the big drivers for that happy medium, if you will, is the unhappy medium of this contest. And what's likely to happen there is that China's not a particularly inflationary economy. If anything, it's a deflationary economy, and that's what we've seen. Whereas the United States is running up against capacity constraints because they don't have a lot of domestic manufacturing, for example, and therefore you're seeing price rises across the board. You're also seeing protectionism with new tariffs in the United States and elsewhere because they fear, losing too much control or ceding too much control to China for essential items. And so the world, we hope, doesn't divide into two blocks. But what is happening is that, you have this upward pressure on prices from tariffs in the developed world and reshoring, which is expensive. And you have this downward pressure on prices from places like China that then expand out into the emerging markets and, build their new factories in other places, Vietnam or somewhere like that, or indeed in Africa. Excuse me.
If I hear you...
Sorry. Yeah,
Kingsley, if I hear you correctly, it's it's less the monetary regime right now that's going to have the vast, the most significant force on the commodity markets. It's the geopolitical regime.
Oh, absolutely. Yeah, that would be that's the succinct way to say what I just said. That's absolutely right. No, you nailed it. We're not talking about a period which spans most of my adult life, which was the dominance of central bank monetary policy. If anything, we're entering a new period, which is in some ways similar to what I remember from earlier days, but in many ways completely different. And the completely different element is that you have these very large populations in China, in India, and elsewhere in Africa that are moving up the curve in wealth that represent relatively underutilized factors of production, labor, land, commodities. They're coming into the economy at the margin. And because that part of the world is sort of being driven by China, India as big consumers, that puts downward pressure on some prices by bringing new factors in. But you also have the upward pressures that come from the energy transition and other things. So the net of that should be a more stable environment, we think. We hope. But that's not going to involve central banks as really setting the scene. Increasingly, it's going to be fiscal stimulus, as we see in the United States with the Inflation Reduction Act. Whatever turns up in China, we're still waiting to see the exact shape of that. But government becomes more important. Industry policy becomes more important. Monetary policy less important. And entrepreneurialism, we would say, probably really is going to rule the roost here in terms of finding your way through this maze of conflicting currents that I mentioned that ultimately going to set the price structure.
Kingsley, you wrote a bit of a tongue-in-cheek comment in one of your wires not too long ago that you spend every waking hour fighting a torrent of disinformation from incredibly well-financed national security think tanks, and that's as it relates to critical minerals. I want to hear what the most frustrating parts about the disinformation that you hear out there are.
Yeah, it is, as you gathered from my verbiage, it's a topic close to heart. And part of the reason for that, for full disclosure, is, in my earlier career, I did spend time in military research. So I was a research scientist in Australia at one of the facilities down in Melbourne, Fisherman's Bend. In those days, I worked on, modelling, different military assets like helicopters for the Navy. So I'm not unfamiliar with where the national security voice is coming from. The only real gripe that I have, and that's what I was referring to with, the disinformation, is that a lot of these folks are very focused on a very small slice of the global commodities pie for any given commodity. So take rare earths, for instance. There's been a study in the United States which shows that US military demand is tiny. It's measured as 1 or 2% of total demand. And the size of plant that would be needed to satisfy US military demand for national security purposes is probably smaller than the plant that Lynas is going to build with some Defense Department money in the United States. So the main concern that I have is that if we devote too much attention to national security, we'll fail to recognize that it's only a tiny sliver of the market. So most of the critical minerals that are going to be produced going forward will be for civilian uses and civilian markets like electric vehicles. And so we need to make sure that we're not distracted by putting too much emphasis on what the military needs as opposed to what society in general needs. Otherwise, what's likely to happen is the military will get very concerned about access to one or other mineral like gallium or germanium. And the demand is so small that they'll be very easily satisfied with a very small smelter addition of a circuit to extract germanium or gallium from a US smelter like they have in Clarkson, United States. And that once the military is satisfied, their interest in the policy is going to disappear because they have what they want. That's not going to work for business. So I think that because 98% or more of minerals demand globally is for commerce, we should have a higher emphasis on the commercial aspects. And that means that recognizing, for instance, that Australia right now with electric vehicles, 89% in the latest data that was released for imports of electric vehicles, 89% of those were China origin, and that market share is growing. So if we're too busy identifying national security risks from trading with China in minerals, we'll forget that we're trading with China in finished product, in electric vehicles, in solar panels, wind turbines and the like, batteries, and we'll just miss the point. We want to put too much attention on very small plants that the military needs and not anywhere near enough attention on what we need to grow the economy. And then you lose your national security because you spend all this time talking about small threats in small markets and you've completely ignored development of capacity and capability, know-how, expertise, application of capital, building plants in Australia or elsewhere, business relationships, because you just spent too much time talking about the wrong thing.
Kingsley, earlier you touched on that dynamic back in 2011, where it was the export policies between Japan and China that really incentivized this upstream rare earth market, culminating in the development of Lynas's Mount Weld and the enormous company that's since become. And to me, that kind of dynamic, it was, on a micro scale, you had these geopolitical tensions between China and another country. In a commodity where there was concentration in China previously, it resulted in two different price points for a commodity selling into two different locations. I think about that dynamic and I wonder if there are analogues between what we can learn back then in relation to that very small, specific closed market and what the world's going to be looking at going forward in relation to the ramifications of the IRA. I'm curious to get your thinking on that one.
Yeah, that is the question. I think that's what investors need to work out. And I can't claim to have perfect foresight or insight on these questions. And they will sometimes be a bit contentious. But let me provide you with a perspective on the 2010-2011 rare earth crisis, which, of course, I was living through in discussions with Japanese prospects. There's a couple of things that are headlines there. One is, of course, this was basically China, was slapping the face to Japan over a territorial dispute. And we could have way more of those going forward because we know that territorial disputes are front and center for tension between China and the United States, for example, or Taiwan for that matter. But the thing is that whilst it started that way, and ultimately a successful challenge by other nations in the World Trade Organization was China to cease doing what they were doing at that time. What's easy to forget is that both Japan and China learned a lot from that episode, and they moved forward with a constructive strategy on both sides. So firstly, the constructive strategy from Japan was to say, well, why are we so reliant on China? Why don't we just, develop new sources like Lynas? And that's how Lynas got into business. And the constructive strategy from China was to realize that actually, when they imposed those export quotas, is how they did it, they actually fractured their own market, because what happened was that the mechanism was to say, we will limit the amount of rare earths that is qualified for export, right? And there's two different pricing structures that go with that. There's free on board, which means, you pass customs, you pass this, you pass that. That commodity is ready to ship, to go internationally. And then there's ex works, which means the factory. Now, normally these two prices, they only differ by insurance and other items. But in this particular circumstance, they were wildly different. And what happened was the ex works price went down and the free on board price went up. And the difference was entirely this regulatory nonsense from China of artificially restricting export. So it had very damaging effects internally in China. And because saving face is important, it took the Chinese a long time to admit that. But we don't think they're going to make the same mistake going forward. So, for example, with MP Materials in the United States, I've written on this before on Livewire, the Mountain Pass mine was gotten back into production, around 2017. And there was Chinese capital that helped with that through Xinye. And initially, when they brought that US mine back into production, it didn't have enough buyers domestically in the US, because the US is a little bit sort of further back in this process than Japan was back in 2010, 2011. So the only way that they could get that US mine back up and running was to do a deal with Xinye, the Chinese company, to send the material into China for processing. And in fact, that's what's been happening. And now, thankfully, Xinye and MP, they have a relationship. Xinye is not obstructing MP from sending that material elsewhere if MP can find a buyer. So that material is now coming back out of the Chinese market and going into the Japanese market, and soon it'll be going into the US market. So we think there are more constructive developments as a result of that former crisis. But that doesn't stop the fact that right now we've got a gallium-germanium crisis because of the whole semiconductor thing. So this tit for tat is the big risk in the trade war between US and China. That whilst we might be out of the woods with the rare earth threat, we now have a different one in a different commodity. And that could continue in other, critical minerals like indium, for example, similar to germanium and gallium, has a very important role in semiconductors. The Chinese don't have as big market share in that, but if they blocked indium, that would cause the next round of the same problem. So we do have to be very mindful of, these geopolitical factors as they play out in the market.
Kingsley, on the topic of the Inflation Reduction Act that Trav just brought up, something we have been hearing a lot about is a potential bifurcation in prices. And some people that we've spoken with have even seen that you're seeing this already in terms of payability that mines are receiving. Do you have a take on the bifurcation of prices, and kind of specifically as it relates to what the Inflation Reduction Act is bringing about with, their incentives?
Yeah, I do, and I can relate that directly back to what I said before. There was a bifurcation of prices for rare earths in China, and what it led to was a natural market mechanism where if you could smuggle rare earths out of China and achieve the high international price, you would. And normally that would close up the price gap, but it was being held artificially high because of the quota system, which eventually the Chinese are well. So if you fast forward to the Inflation Reduction Act and some of these measures on what will be qualifying material to go into a battery under the measures there to earn the tax credit in production. And that maybe incentivizes production, for, lithium that comes from a free trade agreement country with the United States. You'll see effects where material is routed, your material might be sourced as a result from an FTA country, and that can produce in the short term a potential premium for material. But then the arbitrage kicks in into new areas where, it might look good for Australia at the beginning because we have an FTA. But if it's possible to bring in production in another FTA country like Chile, but not Argentina, then, you can have a shift of capacity into those areas. And it's not obvious how that will play out in this market. So to give you an example, Chile has an FTA into the United States and therefore qualifies, but Chile is also a very attractive destination for Chinese capital. So BYD, the Chinese automaker, is building plants in Chile. And so you may find a situation where countries that have good relations with China in respect of being open to Chinese investment, but who also have an FTA with the US, are actually able to generate opportunity shipping to both parties. And this is what we call kind of an intraprot, so-called environment, where, as it often happens when you have trade restrictions, those nations that are open to trade with either party in the dispute are actually the winners. The parties that align themselves only with one buyer have artificially reduced their market share. So in the short term, they may succeed, but in the long term, they probably won't get the benefit of it because trade flows will divert, as it's called. Stephen Roach in the AFR, who's a well-known economic commentator, he wrote as much, I think it was yesterday, on trade diversion as a result of trade tariffs, and how, for example, Mexico was replacing China as a major exporter to the United States, but on the other side, Mexican imports from China were rising. So instead of the former trade China-US, it's China-Mexico, Mexico-US. And you'll see lots of versions of that, we think. So it's not bad for Australia, but we may not necessarily have the positioning in the marketplace to be the ultimate beneficiaries of that effect to the best or highest degree. It's more likely to be a nation like Chile or a nation like Mexico, possibly, or indeed Morocco, where we're seeing investment because they have an FTA. So there are important things to bear in mind in the context of how the Inflation Reduction Act and other US measures are structured around, where the material can come from to qualify to be included in that system.
So ultimately, in your mind, because commodities at their core are fungible, there will be arbitrages that, despite the fact that you have different incentives in different countries, opportunistic arbitrages will find a way to find a middle ground. So I guess I'm curious, sort of, with that thesis, who are the real winners in the commodity game as a result of the IRA? And I'm talking not just country level, but more like what types of projects are going to be the real winners?
Yeah, that's a great question. So let's take lithium because it's the one that I'm closest to right now. I think because, headline, this market is growing at a great rate. I think McKinsey was saying 20% CAGR. Who cares? The number's somewhere between 10 and 20%. It's significantly higher than it used to be at 8%. And that's because EVs are now, the dominant source of demand. And batteries the dominant use for lithium at over 80%, according to the US Geological Survey. So when you get into that analysis of who the winners will be and so on, here's a market that's growing at a really high rate, where historically Australia has really been trading places with Chile to be the number one producer. And let's remember, when you ask the question, types of asset, Chile, as people will know, is brines, salt pans. They can take a long time to bring into production because you have to qualify the material. Australia's hard rock, where we do some processing onshore. We've got terrific opportunities for more downstream processing in Australia, but we also have to be clear the cost structure of doing that processing in somewhere like China, somewhere like South Korea, is probably better. And so therefore, when you talk about winners, I think there'll be winning partnerships, if you will, across the supply chain. And so you might want to put flags on that, and you might want to put names on that. So let's put flags on that. I think Australia into China for lithium, the numbers are maybe 95% of it is going to China right now. At the margin, because South Korea is the second biggest battery manufacturer, I think you've got to see them take share from China under that relationship. South Korea can FTA into the US. So Australia via South Korea to the USA is one axis on the flags. And on the companies, you identify who are the major Korean companies like POSCO that have knowledge and expertise in this area, and they'll be partnering with Australian companies. So then, as you get down to it, what you're probably doing, at least what I'm doing, and I think it's just natural, I think other people are doing it as well, is they're saying, okay, well, let's carve out the supply chain. We've got downstream, we've got the cars, Tesla, Ford, whomever. Upstream from them, we've got the batteries, SK, Panasonic with Tesla, cattle in China, Goshen, others. And then going into the batteries, we have those midstream players, Albemarle in the US, Tenke, Garfeng, SQM out of Chile. And then you get to the Australian miners and it becomes a game of, well, who's partnered with who? And for us, as an example, a concrete example for investors, we bought into Azure, which has that very promising, discovery up at Andover at a little over $1 because we were a bit slow. My partner and I were talking about it when it was 30 cents, saying, well, maybe you should buy this, maybe. And then we're too late, right?
Everyone's too slow on a new discovery.
Yeah, exactly. And then we bought in a little over $1 and it was like, look at each other. No, that makes sense. I mean, let's just get a rough estimate of size. There's upside here. But, if you look at it and you ask yourself the question, as we did, around the 30-cent mark, maybe we should look. Well, that's because SQM had already taken 19.99%. The Chilean guys who really know Lithium well. And remember, it's green bushes and all the rest of them. So SQM knows this stuff. And if you talk to geos, they'll tell you, well, we can't be sure until we assay whether we really have lithium in this thing. But certainly spodumene sort of stands out in drill core. If there's grey white and it looks like spod, then probably is. And SQM had bought in 20% of that company just basically on the basis of rock chips early drill core. Said, we'll buy 20% of the company. And you're going to need to do that more and more, is assemble who are the likely players in a daisy chain that goes from mine to the end product, work out who's got a good commercial position, and really pay close attention to what those players do. And maybe you buy all of them, or maybe you just buy some of them. But if you're not following that news flow, and you guys, I understand, have got an investment banking background, so you'd be well familiar with this thought process. If you're not thinking who's going to buy whom, why, when, where, then you're probably going to get left behind, because there's plenty of spodumene and other resources out there. But the folks that get up are going to have the right combination of grade, resource size, and partnerships, and management that knows how to do the right deal when.
Kingsley, we've seen, so on that point of vertical integration, we've seen numerous issues across WA, like Kwinana comes to mind, Mount Holland with SQM and Westfarmers come to mind, and there's been heaps of delays and issues ramping up. Are these just teething issues in your mind? Is this inevitable in Australia and Western Australia that we're going to see this downstream sooner or later running effectively?
Yeah, I think it's probably a teething issue, but let's step back and recognise that in the West, the scale of the prize is huge, but as we know from the history of minerals development in Western Australia, it's a very big place, and it can be hard to get the labour and materials and other things where you need them when you need them, and it can also be a little bit hard to sustain the necessary engineering capability and knowledge from one project to the next. I was talking to a good friend of mine who's an expert in, corporate strategy, and he was telling me that, the biggest problem when you do big projects like Kwinana or indeed reshoring and remanufacturing in the United States, the hardest thing really is this aspect of keeping the right knowledgeable people together from one project to the next project, so you can have an unbroken chain of development to really grow an industry. And we've seen WA surmount that before, with the growth of LNG and the growth of iron ore, name two. And we think with the evidence that we see in the marketplace with Kwinana is it is a teething problem, and it will focus attention on the need the urgent need, I think, to look beyond our traditional focus in geosciences, discovery, exploration, and mine engineering to these inorganic chemicals problems of processing. And we're going to really need to have that post-it note front and center on the board. Let's learn as much as we can from joint venture partners and from watching what is done in the leaders in this area, which is China, Japan, South Korea. See how they do it, and really try to learn as quickly as we can how to make sure that our chemical plants are going to operate to spec, on time, and on a sustainable basis, on budget. And that's kind of what we're seeing with these startups in Wenata and elsewhere. And you'll recall, of course, earlier Australia had a big go at laterite nickel, and that was less than fully successful in the early attempt. And that's for similar reasons. You've got these high capital expenditure projects with some significant chemical engineering knowledge that's required. And so you just need to be aware of that.
I think we can segue from lithium to iron ore now, Kingsley, and you've talked a little bit about the parallels between the two industries as they've emerged over time. But one view that you do have on iron ore is that the floor price is not $60, but rather $100 due to the market structure in China. Can you speak to that a little bit? What's the market got wrong when it thinks about the floor price?
Yeah. So let's start with the obvious thing. We do know from the reports from Rio and Fortescue and BHP what the cost structure is to produce iron ore. At site, at mine, or free on board, shipped. And so we know that that's significantly lower, and that's recognizing that is what supports the argument that the clearing price should be lower. But we need to factor in the geopolitics here, is that China's not unaware that they're very dependent on Australian iron ore, and they keep complaining about price for that reason. And that's why we saw that downward pressure from the Chinese authorities talking down the price whenever it gets above 120. Remember it went to 220 and they just went completely mental. And we saw all kinds of measures to get the price back down. So that tells you that there's a ceiling there, which is when the buyer kind of disappears. And we know that that's somewhere in the 120 to 150 range at the margin, particularly for a low growth market like iron ore globally. Okay, so that first price I mentioned, clearing price for BHP, Rio, and so on, that's too low. We know roughly where the ceiling is, so we've got to figure out why 100, why not 80, why not 90. On a short-term basis, it's probably 80 to 90. If you put a line through the chart on an average basis, it's probably about 100. So what is setting that price? Well, it's the fact that about 35% of China's needs come domestically, and they don't have high-grade hematite like we do. They have to beneficiate, magnetite type ore and others, and they don't necessarily have the same scale of deposit that we have in Australia. So there's a significant part of the cost curve that's higher up as a result. And what we do know is that Chinese steel mills, indeed steel mills all around the world, they do value these very high-grade hematites that Australia can offer, the 63, 65% that you get out of smaller ore deposits. And they like to be able to blend that with their other product to feed blast furnaces. So we know that at the margin, there are two sources of iron ore that are frankly marginal. In Australia, you've got folks like Range Resources with magnetite. You've got Champion Iron up in Labrador in Canada. You've got Phoenix as an emerging player in WA. And they're all kind of high-cost producers around the $80, $85 or higher in some cases. But they're selling higher value products, so they can eke out a living that way. Over in China, they're doing the opposite with bulk beneficiation of lower grade ores that they probably need to blend anyway to get to where they want to be. And that is the other part, the other jaw of that equation in setting a significant part of the cost curve at prices well above 60. And that's all we're saying is that, don't think marginal cost of production relates strongly to BHP and Rio because they're so far down the cost curve that any demand retrenchment in China never touches that portion of the cost curve. It's only the higher up piece, and that's the basis for our argument. And you'll note that it's actually quite hard to assemble a proper cost curve here that had full accounting for that, because we're talking about roughly 30% of the Chinese market being very opaque. And so it's really, really hard to know what that is. But we also know, just like Phoenix in Australia, the Chinese who are trying to mine these deposits, they've got big logistical costs to move the stuff around as well, because they don't have, the benefit of the Pilbara. And that's no doubt why they're prepared to put a lot of money into Simandou and elsewhere to try to break this nexus and get their own, if you will, captive supply of high-grade material so that structure changes. If that happened in a big way so that you were less reliant on Chinese domestic sources, then that whole cost curve structure would change. And I think those bears who are saying $60 is where it should be, that would be proven to be correct. But that hasn't happened yet. So that's why we say it's at least $20 to $30, if not $40 higher than that.
Kingsley, you mentioned some of the higher grade producers, and a company we've spoken about in the past that comes to mind is Mount Gibson. And this is, somewhat of a side note to the broader point on iron ore, but they obviously had the history with the pit getting flooded. And I want to hear how you think about and hedge tail risks and black swans like that in your investment process.
Yeah, it's a great question. In the case of Mount Gibson, I can come clean, full disclosure. We actually owned the stock before the pit flooded, and therefore I have to say that in that instance we didn't hedge, because it never occurred to us that something like that might happen. But that's normal in investment land. When it does happen, and you're not hedged, that's because you didn't anticipate that could happen. And so there are the anticipated problems and there are the unanticipated problems. In terms of our portfolio structures, we don't actively hedge like a producer might. So if you look at a Phoenix, they did some very successful hedging at high iron ore prices, and that was a very good move for them. And they did that because they've got short mine life, and therefore they can do the economics at the margin of hedging, and it makes a lot of sense. As portfolio managers, we don't hedge in that way. In fact, mostly we prefer producers to be unhedged. But as I just mentioned, we can see rationale for doing it when you have that sort of situation. So the way that we hedge then is we try to hedge by commodity, by jurisdiction, by mine deposit, more than in taking any active position in the commodities markets. That's our preferred thing. And that's just because we know how to do that. And diversification is relatively easy to present to investors as your rationale and your process for managing risk. So position size in any individual name, appropriate hedging. I can recall a previous, life, if you will, as a portfolio manager running the team, running a very large book of globals investments. Some people might remember Deepwater Horizon when there was the explosion in the Gulf of Mexico. We happened at that time to own all three companies that were at the center of the problem. And we couldn't know that the thing was going to blow up in the way that it did. But we owned all three companies. But I'm happy to say that whilst we're unhappy to report to our investors that we owned all three companies, our position sizing was such that it had very little effect on the overall portfolio. And so we were able to actually do that. On other occasions, it hasn't worked out so well. And that's why we continue to emphasize diversification as the main way to hedge. And recognizing that we don't, we can all be confident in our statements. And, anyone who's followed me over the years knows that I can always be terribly, terribly confident in my view on something. But we're also quite aware that there's many things that can change in the world that mean that what you thought yesterday, you no longer think about the future. And therefore, diversification is, to our minds, the best way to hedge.
Touching on opaque market visibility in China, we're kind of keen to look at graphite. I know this is a commodity that you've got some thoughts around, and as we understand that market, it's really, really, really challenging to have any good insight to that market in China. So given that there's a large array of graphite hopefuls on the ASX, and they relate, pertain to Australian investors, how can they think about and make sense of that very opaque market dynamic?
Yeah, that's a really, really good question. And we struggle with it in China to really understand the synthetic graphite market and where the stuff's coming from and what's happening. And if I might use an adjacent example of rare earths, it's a little bit the same with the rare earths, is that there's a lot of separation plants in China. And it can be really difficult to understand the unit economics, which I think is the problem in trying to come up with forecasts for graphite price. Okay, is that if you don't have good data and you don't know the unit economics for production at the margin, it's hard to construct the cost curve, and then it's really hard to work out what exactly are the swing producers and what the incentive structures are. That's one of the key things. So in China, is graphite being produced for some kind of social purpose, or is it ultimately set at the margin in selling price by need, commercial need? Now, that's just the way things are. So to answer your question directly, what should producers be doing? We think that vertical integration is one strategy which shows a lot of promise in these opaque markets. And the reason I say that is, remember, vertical integration is that strategy where you try to own bits of the supply chain, maybe not all of it, but bits of it, where the extent of your control is large enough in different steps of the production chain that you effectively you don't care so much about an intermediate price. So if there's an intermediate good like the sort kind of graphite that might go to an anode manufacturer, or to somebody who prepares it to go to an anode manufacturer, if you own those pieces, then you can observe a market that you sell into for the anode material as finished product. So if you own enough of your upstream chain, you can get visibility on your cost of production to know that you'll be profitably operating a mine, like, for example, what Syrah Resources is attempting to do and going downstream. And then you just need to make sure that you cycle your production rate in order to keep your total vertically integrated operation profitable. And we have seen signs of this already, not in graphite, but you would have seen with the Lynas announcement, the prices are too low, so they'll be stockpiling NdPr material so that they can deliver it against their client needs in Japan. So that's an example of the kind of, shall we say, explicitly non-market behavior.
We see it in China all the time.
It is the smart thing to do.
Totally, yeah. But you can only do it when you have, like a market that does not have perfect competition, to say the least.
Yeah, exactly. And if you think of Tesla, Musk went out early, to his credit, with a plan to say, well, we're going to be vertically integrated. Why? Because we're in a rapidly developing industry technology-wise, so we'll keep in-house the bits that make sense to keep in-house, and we'll put out-of-house those that, we think we're comfortable from buying from anybody. And he was making the point that we need to innovate rapidly. So the things that we're going to keep in-house are those things where we know we're going to have our own specification that we discovered from being in business doing this, right? And we'll learn faster than other people which bits should be in-house and which bits should be outside house. And that's smart, right? And it's not new. It's what Henry Ford did back in the early days of motor vehicles. It's what Lynas is doing now, holding some material offline. It's what we would expect to see. You can run into problems with trade rules and so on, but I think the way things are going with trade tariffs and so on, you're kind of not worried anymore by that. You just need to make sure that you don't have transfer pricing problems with taxation, that your customers ultimately are happy. Because if customers aren't happy, you won't have business.
Kingsley, conscious of your time, there's a few more topics we want to quickly touch on. So one of them is groupthink, something you've written about in the past, and the pitfalls of groupthink. And, something we at Money Mind discuss is the kind of need to be a contrarian, especially in commodities and investing. So just a nice and basic question on this one. How do you avoid groupthink as an investor?
Yeah, you have to question things, especially yourself. And I think you have to remind yourself of when you've made mistakes and learned from them. And then the other dimension of groupthink is actually the scientific background that I mentioned earlier, is that having critical thinking skills, wherever you obtain them from or however you develop them, is really important. So if there's a commonly stated assertion, you need to question whether that's really correct. So, for example, it's been commonly asserted that the US is short of rare earths, and that could be posing a big problem in respect of reliance on China. Actually, if you do the math and you look at the trade data and you look at the MP materials output, you can certainly make a case they're short of heavy rare earths, which is why the Department of Defense is financing Lynas to build that plant. But they're most definitely not short of light rare earths. And in fact, if you look at the trade balance, and this is an example of avoiding groupthink, the US is a net exporter to China of NdPr, the magnet materials, to the tune of about, by our estimates, about 4,800 tonnes a year out of 6,600 tonnes produced out of Mountain Pass. So that's how you avoid groupthink. You go ask yourself, well, is that really right? I can see this is mine, but where's the stuff going to? That's all public knowledge. You go do the research. Then you ask yourself the question, well, is there any other source of information I can use to construct the trade balance I just mentioned? And indeed there is. If you use the US trade data, which is very good, and this might surprise some people, if you use the China customs data, which is also very good, then you can match up, pretty much pound for pound, what's going out, what's coming in. And you can also recognize what the category of material is. And that's how you avoid groupthink. You actually do the research with a critical view. You don't kind of get lost in crazy conspiracy theories, as much fun as it might be to get ChatGPT to invent them. But you do that research, and then you form a view. And then, of course, you need to check that, right? So when I go around talking to company executives in rare earths, for example, I'll be asking them questions to see how they're going, and not leading questions, more giving them an opportunity to express how they're doing on negotiating offtake in different places like South Korea, Japan, United States, or Europe. And you'll glean information from those questions that either supports or refutes your hypothesis. And that's a continual process. You just keep doing that. And that's how you avoid groupthink.
I'm sure also being based in Canberra, you'll do just fine avoiding the groupthink of the Melbourne and Sydney fundies, mate. So,
yeah, we just have the groupthink of our politicians. But yeah, look, I consciously, when my wife and I moved here, because I had been a student here, I'm not from here, from Melbourne, and we spent many years in Sydney, but I consciously was reminded of Warren Buffett's edict that, yeah, well, in Nebraska, you didn't have all that noise, right?
I love it.
And so he's quite happy staying there. And I can see why now, having been in Canberra for 3 years.
We hear the same rhetoric from the Cottesloe-based fund managers here avoiding West Perth.
There you go. I know where to avoid now. I won't go to West Perth. Just stay away, right?
Kingsley, we'd love to finish with a bit of a quick fire round. And how we're going to structure this one today is getting your take on whether what we're going to say is overrated or underrated, and whether you can, get that out in one word or one sentence. So, Trav, start us off.
Yeah, quick fire. Overrated or overrated or underrated? Okay. Going downstream in lithium in Australia.
Underrated.
Chalice's Julimar project, if you're familiar with that one.
Overrated.
Azure Minerals.
Underrated.
The hype around copper at the moment.
Underrated.
Niobium.
Overrated.
Patriot Battery Metals.
Overrated.
Oh.
Dreadnought.
Underrated.
Direct Lithium Extraction, or DLE.
That's another curly one. Underrated.
Tin.
Underrated.
Graphite.
Overrated.
Ramifications of the IRA.
Underrated.
Long-term lithium price forecasts.
Overrated.
Lynas.
Oh, underrated.
Lucky last, IGO.
Oh, underrated.
Oh, brilliant. Mate, you're the first person we've had on that's actually given succinct answers when we've asked for our rapid fire round. So well done.
Kingsley, I found that awesome. Thank you so much for coming on, making the time for us. We really appreciated that, and we think the money miners will get a lot of value from the discussion we had.
Oh, my pleasure. I think you're doing a great job, guys. It's so nice of you to reach out, and I think that this format is just wonderful. I like it. I do drone on, but it's nice.
We appreciate it, mate. Thank you very much.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.